Hi finance besties, and welcome back to my channel. Today I'm explaining all the US tax deductions and credits that are available to business owners, to individuals, to high income earners. So stay tuned and watch till the end. If you haven't already, please click on the subscribe button and subscribe to my channel. Also, please like, comment and share this video with all of your US friends, either those in business or those that earn salaries or those that are high income earners. And of course, I have my notes with me today because I want to make sure that I'm giving you the right and correct information. So most Americans are paying so much in taxes today, not because they earn so much money, but because they just don't know what deductions or what credits are available to them. So today I'm breaking down every US tax credits and deductions that are available. I'm starting with business owners, and then I'm going to individuals, and then I'm going to mention, or I'm going to talk about the high income earners. I'm a certified public accountant licensed with the Minnesota Board of Accountancy, and I'm also licensed to file taxes in all 50 states in the United States of America and represent you or anyone before the IRS in tax courts. My goal today is to help you keep more of your money legally. So let's start with the business deductions. What qualifies as a business deduction? The IRS allows you to deduct expenses that are ordinary and necessary for the smooth operation of your business. This applies whether you are a sole proprietor, LLC, S-Corp, or C-Corp. So first, let's talk about the ordinary and necessary business expenses. These usually are the most common deductions. Examples are your office supplies, your software, your subscription, marketing and advertising, websites, accounting and legal fees, business insurance. The rule really is that if this expense helps you to make more income, then there is a strong chance that it is tax deductible. The second deduction that some business owners that I have worked with in the past did not really know about is the home office deduction. So if you work from home and you use part of your home exclusively and regularly for your business, you may qualify to take that deduction. And again, we're talking about the home office deduction. With this deduction, you can deduct a portion of your rent or mortgage interest. You can deduct a portion of your utilities, your internet, your property taxes. There are two methods of doing this. There is the simplified method, and then there is the actual expense method. Usually I go with the actual expense method. I would recommend that you go with this if you have, enough expenses to deduct. One thing that you must keep in mind though is that that space must be exclusively and regularly used to run your business. So how this home office deduction works in practice is that you take the total square footage of your home, you take the total square footage of the part of your home that you use for business, and then you divide it. So let's say that your total square footage is 1600 square feet, and then let's say you use 300 square feet to run your business. So you would do 300 divided by 1600, and then whatever that percentage is, that's the percentage that you would apply to all of these expenses. So still staying with the same example that I just gave, the total square footage of your home, of your house is 1600, but the space that you use exclusively and regularly for business is 300 square feet. That means that 18.75% of your entire home is what you use for business. So you would take all your utility bills, for example, for the whole year, and then you would take out 18.75% out of those utility bills, and that is the amount that you will use for your home office deduction when you're trying to deduct your utilities. The next business deduction is the vehicle and mileage deductions. With this, you can deduct business vehicles, and you can do this in two ways. The first is a standard mileage rate. So this is where you enter in the mileage that you used for business on that vehicle. The next way you can do this is actual vehicle expense. So just like the home office deductions, if you had lots of expenses, lots of business expenses on your vehicle, I would recommend that you actually list out all of these expenses. So if you're listing out these expenses, examples of the expenses that you can deduct are gas, maintenance, insurance, depreciation. One thing to note is that you must track your business miles, and commuting does not count. The next business deduction that we're going to talk about is depreciation, section 179, and bonus depreciation. The one big beautiful bill that was passed in July of 2025 reinstated the 100% bonus depreciation. What this means is that there is no limit, so you can use the bonus depreciation to create a net operating loss. Also, there is no phase out amount, and the strategy to using your bonus depreciation is to use it after you've maximized your section 179 expensing, and we're going to go over that next. To be able to use this 100% bonus depreciation, your property must have been acquired on or after January 20, 2025. If not, you get the 40% bonus depreciation. Examples of qualifying expense for bonus depreciation are your office equipment, your vehicles, heavy machineries, computers, technology, land improvements like fencing, like landscaping, parking lots also qualify for the 100% bonus depreciation. Lastly, interior improvements made to non-residential properties like roofing, your HVAC, your security systems also qualify for the 100% bonus depreciation. Next, let's talk about the section 179 expensing. New guidelines for the section 179 expensing as enacted by the One Big Beautiful Bill Act, which was passed in July of 2025, increases the deduction limits and it makes the provisions permanent. And these changes are effective for qualifying assets placed in service after December 31st, 2024. So what this means is that you need to have placed the property in service by January 1st, 2025. Previously, the maximum deduction limit for 179 expensing was 1.25 million. After the One Big Beautiful Bill, this amount was increased to $2.5 million. So technically, it was doubled. So what this means is that you can use section 179 expensing to write off a property or a business asset that you bought up to $2.5 million. But remember that this asset or this property would need to have been bought and placed in service after December 31st, 2024. Also, the phase-out threshold has increased to $4 million. In the past, it was about $3.13 million. And then Section 179 expensing is now a permanent part of the tax code. And this provides greater certainty for your business or your tax planning. So two things to note before we move on to the next. The strategy for using the bonus depreciation is to first of all use the section 179 expensing. When you've used up your section 179 expensing, then whatever is left, you can use the bonus depreciation on it. The second thing to note is that to use the bonus depreciation, you must have bought the asset or the property on or after January 20, 2025. If the property was not acquired after January 20, 2025, you only get the 40% bonus depreciation. For the section 179 expensing, that asset or that property must be placed in service after December 31st, 2024. Next, let's talk about your meals and your travel deductions. Business meals are generally 50% deductible, and this includes meals for your clients. It also includes meals while you're traveling for business. Entertainment is no longer deductible, but business travel expenses like flights and hotels are deductible. The Tax Cuts and Jobs Act of 2017 eliminated deductions for activities that were generally considered entertainment, amusement, or recreation, even if business is discussed. So examples of non-deductible entertainment expenses are tickets to sporting events or concerts, golf outings, or memberships to country clubs. Next, let's talk about payroll, contractors, and employee benefits. Businesses can deduct employee wages, payroll taxes, health insurance, retirement benefits, or your 1099 contractor payments. Next, let's talk about major business tax credits. Credits are usually more powerful than deductions, and this is because they reduce your tax bill dollar for dollar. I will just mention some of the key US credits that we have. First one that I have here is the Research and Development Credit, which includes startups and tech businesses. I have here the Work Opportunity Tax Credit, which is for hiring from targeted groups. And then I have the Small Business Healthcare Credit, Employer Retirement Plan Startup Credit, the Clean Energy and Commercial EV Credits. If you have any questions, please leave them in the comments and I'll be happy to answer those questions. Before we move to the individual parts, let's just quickly talk about some other things that you can do as a business owner to be properly prepared for your taxes, or things that you can do to legally reduce your business tax bill. First thing that I have here is income and expense timing. This works best for any year that you have with very high revenue. With this strategy, you're making sure that you are paying your vendors quickly in that current year where you experienced high revenue. You have to do this before the year ends so that you are able to deduct all of these business expenses against the revenue or the income that you earned. Also, on the flip side, if you feel like invoicing a customer will take you to the next income bracket, then you can discuss with that customer if you are able to delay invoicing till the next year. The next is employing family members. You can pay your children and your spouse to work for you. Money paid to them is tax deductible because they are acting as employees now, or contractors as the case may be. For the children, it may be tax free for them or at a lower tax bracket. Now, there are things to be careful. Now, there are things that you need to watch with having family members working for you. Make sure that the job that they are doing is age appropriate, and then make sure that they are actually doing real work that adds to, the income that the business is making. The next thing we're talking about is donor advised funds. With a donor advised fund, you get immediate deduction for your charitable givings, and then you can decide what charities to give over time. With the donor advised fund, you don't have to distribute the money immediately. You can just keep it in that fund, get the deduction, and then over time decide what charities you want to give those funds to. You can contribute cash to open a new account or to add to the money that you have in an already opened account. This contribution is tax deductible in the year it was made, and the funds can be invested to grow tax-free. Now, there are key limits and rules for donor advised funds for 2025. First is cash gifts. So if you're doing cash, you can deduct up to 60% of your business's AGI or your personal AGI if you as the owner of the company is itemizing your taxes. The next one is non-cash gifts, so appreciated assets. With this, you can deduct up to 30% of your AGI for assets held long term, so assets that you've held for over a year. And then if your contributions, either cash or non-cash contributions, exceeds this limit, so remember that for cash it's 60% of your business's AGI or your personal AGI if an owner is itemizing, and then 30% of your business AGI for non-cash gifts, or you can call them appreciated assets. So if your contributions exceeds this limit, you can carry it forward and deduct it for up to 5 subsequent tax years. One thing to remember is that donating appreciated stock avoids capital gains tax and also provides full market value deduction. The last thing we're talking about as far as things to do to legally reduce your business tax bill is investment and real estate. Utilizing depreciation on real estate property can create a loss on paper. The 1031 exchange can be used to defer capital gains tax when you sell your property and then you reinvest the proceeds into a like-kind property of equal or greater value. One thing to remember is that there are strict timelines that must be adhered to. Lastly, you can invest in municipal bonds that are generally free from federal taxes, and sometimes they are free from state and local taxes. Now we've come to the end of business tax deductions and credits. If you have any questions, please leave them in the comments and I'm happy to answer. If you haven't already, please click the subscribe button, like and share this video with all your US business owners. Using the 1031 exchange, which is where you defer your capital gains tax when you sell your properties and then reinvest the proceeds into a like-kind property of equal or greater value. And I will see you in my next video where we're going to talk about individual taxes and taxes for high income earners. Bye.